Hi everyone, my name is Pham and I am recording this video to explain an example, to explain a spreadsheet which shows the example performance fees and typical distributions to partners of my Pham investment fund and the proposed partnership agreement that I'm working on right now with securities attorneys. Good, it's running live right now. So the original Warren Buffett originally ran a partnership from about 1959 to about 1965. The actual agreement is listed online here at Guru Focus. There was a good answer on Quora, but I think it was taken down. So this is the original text, which I can send out, but it's very short. It lists the original 1, 2, 3, 4, 5, 6, 7 limited partners, which are friends and family, their contributions, which, and so this is just a certificate of partnership. It was not the agreement itself, so we have to piece together what it was, but what we have is a short description in interviews with Buffett and his partner Charlie Munger and other people who have cloned his approach, like Monish Pabrai, of 0,625. So typically in a hedge fund, they describe their fee structure as 2 and 20, which means they get 2% of assets under management just for showing up to the office or even raising the fund. So they don't have to do anything else. They could perform terribly that year. They could, abscond with the funds and, well, maybe not that bad, but they would take 2% off the top, skimming off the top no matter what happened, and then 20% of the upside. And, there are other fee structures like 4 and 40, which means 4% of assets under management just for showing up, and then 40% of the upside. And there's a joke, why do hedge fund managers charge 2 and 20? It's because they haven't figured out how to charge 3 and 30, or they can't get it from their clients. So 0,625 means that there's 0% performance fees, and there's a performance hurdle of 6%. So the general partner who makes all the investing decisions must achieve greater than 6% annual returns in order to eat. So if he doesn't perform, he doesn't eat, or he has to live off his previous distributions. And then the 25 is he gets in performance fees 25% of the upside. And then the limited partners get 75% of the upside beyond the hurdle. And they can keep the hurdle completely. And if there's a loss, that is completely borne by the general partner bears the losses equally with the limited partners. And there's no limited liability. Well, there is beyond the fund, but whatever you deposit in the fund could go to zero in the worst case. And that is equally borne by all the partners, general and limited. So in red here, there's an important note. These transactions represent example distributions and performance fees only of what we are drafting in the partnership agreement. They are not guarantees of performance, and they only demonstrate all the cases of performance fees. For example, not positive gain for the year, but not meeting the performance hurdle. Positive gain for the year, surpassing the hurdle, and then performance fees are collected. Negative, so a loss for the year, in which case no performance fees are paid, and all partners bear the loss equally. And then example distributions to pay for tax liabilities or tax credits. And to keep it simple, if there's a loss for the year, there's a tax credit to all the partners, but that is, we don't ask partners to pay back a distribution. In that case, they can choose to reinvest later, and then we pay them the same distribution for a tax liability in the following year, and it's up to them to keep track of what credits they have from the past that they can use to offset their liability. We'll still issue them a Form K-1 and rely on them and their accountants and a tax professional to do with that information what they will. And then there's also the option for limited partners to add additional cash, but only at the end of the year, and also to make withdrawals also at the end of the year during the term of the partnership. So what are the parameters? The first is the annual hurdle, which we've set here as 6%. The managing partner must surpass this in order to collect any fees. The performance fee of any upside beyond the hurdle, in this case 25%, goes to the general partner, 75% to the limited partners. What is the tax rate? So this is a typical, for Oklahoma State and federal together, is 21% for long-term capital gains, which is capital assets held for 1 year or longer, which the reason why we only report the gains or losses at the end of 1 year is to take advantage of this long-term rate as opposed to the short-term rate. We are not in the speculative business of trading in and out, so we will hold assets as long as we can, and then pass on these long-term rates to our partners. And then finally, what is the general partner monthly salary? That's not material to anyone except for me. This is an aspiration for me of what I will deduct to live on from my share of the performance fees. So the first year, the months are listed here, January through December, and the first year we start on April 1st. Again, that's an aspiration. It may be a month later. And so all the balances listed are for the end of business day of that month. So to start on April 1st, the balance would be that listed end of business day on the last day of March 31st. And we have 2 limited partners and myself, the general partner. Limited partner 1, LP1, deposits $3 million. Limited partner 2, LP2, deposits $1,000. And then the general partner, myself, deposits $1 million. So the total fund assets under management is $4,001,000 on the first day. And so for the year 2022, this demonstrates a prorated startup of the fund. And so for the performance fees, it's only for 8 months, 4 months less than later years, but it ends on the calendar year, December 31st. For simplicity, we don't shift the fiscal year to be April 1st to April 1st. And for this year, let's say we have an annual gain of 9.77%. So has the annual hurdle been met? Yes, 9.77% is greater than 6%. What is the upside beyond the hurdle? It's 3.77%, so 9.77 minus 6. And then what is the annual performance fees that go to the general partner? It's 25% of 3.77%. And, I chose these random numbers. I will carry it out to 2 decimal places. If it's material to carry out to more decimal places, I'll examine that later. So the pink lines are at the end of year. So at the end of the last day of December 2022, the balance, is the same month to month, except for the general partner who deducts a monthly salary to live on. And the gain for LP1 is $264,000, which is added to their balance only after the last day. And then the tax liability, which is 21% of the annual gain. And then this is distributed every year the last day of February, so that limited partners can make tax preparations and pay and file before April 15th. And this will have to be examined, because I think above a certain amount, they have quarterly tax liabilities, in which case we should make distributions once a quarter, and this should be divided by 4. So TBD. LP1 has this balance, which has an annual gain of $125 with a corresponding tax liability, and they receive corresponding distribution. And then the general partner, also experiences a gain on his balance here. He also has a tax liability, which is withdrawn here in addition to his monthly salary. And then you can see the assets under management grows accordingly over here. So next year, 2023, what is this meant to demonstrate? It's meant to demonstrate meeting the performance hurdle. I think I made a mistake. This is meeting the performance hurdle for a full year. Let's say we gain 10% this year. The upside is 4% beyond the hurdle, and then 1%. Now I made the math nicer here. 1% is 25% of the 4% upside, goes to the general partner. The 3% of the gain goes to the limited partner. And again, these are very similar to the previous year, but slightly larger because it's 8 months of gain as opposed to 4 months. So there's a tax liability for everyone, which is distributed in February, and the general partner continues to withdraw monthly salary. Well, I'll carry this out later, but that part's not important. All right, so then next year, 2024, what is this meant to demonstrate? This year, we didn't meet the hurdle. So let's say we only had an annual gain of 4%. This did not meet the hurdle. There is no upside beyond the hurdle, and so then no performance fees. And everyone still, experiences a gain, but they don't have to pay fees. So they keep, up to the 6% hurdle. And this is the gain and tax liability for LP1, the gain and tax liability of LP2. And then the general partner still experiences the gain less than the hurdle, but no performance fees here. And, it could be a period of years. So the general partner is definitely playing the long game. And on average, we'll have enough to live on from performance fees. So next year, 2025, this year we exceed the hurdle. Excuse me. And this year we'll also demonstrate what it looks like when LP2 adds an additional $1,000, LP1 withdraws $1 million at the end of the year. So let's say this was a really good year. We had 14% gain. We met the hurdle. The upside is 8%, and so 25% is 2% goes to the general partner. Again, the annual gain and tax liability of LP1 is shown here, and they take out a distribution of $1 million. So the partners are allowed to change their balances, including up to withdrawing completely at the end of the year, and that's counted here. So that takes it out of the balance. And then the same for LP2. The distribution is positive means withdrawing, negative means depositing. And so that's why LP2's balance increases by this amount here. Tax liability distributions are the same as before. And this year, the general partner does collect performance fees and then experiences the same gain on his share of the funds. And that's it. You can see that this continues on indefinitely. The actual length of the fund, I think, is not important. It could be a fixed term, or I could include in the partnership agreement that it continues indefinitely until I decide to close it down, in which case I'll give the partners probably 1 year notice when I wrap up the fund, and then probably also write a nice annual letter every year to go with the partnership K1 forms. And then when I wrap up the fund, I'll probably provide some advice about what to do next if they wish to continue the investing game, which I hope we all do. Okay, that's it. I welcome questions. And I know there are there are probably sort of a lot of unanswered things to bring up, but hopefully this makes it more clear. And then I will consult with my own accountant to decide, the questions that we mentioned before. Thanks, everyone, and we'll be in touch.